Hey everybody, I'm James. I'm a certified public accountant, and this is another episode of the Crypto Accountant. As always, this video is not financial, tax, or legal advice, and you should consult your tax professional. I've been getting a lot of questions on Twitter regarding the taxability of airdrops and if they're considered ordinary income when they're received. And the appropriate answer really is that it's complicated, and it depends on your specific situation. You're going to need to consult with a tax professional to argue using the current past regulations in the Internal Revenue Code. And it will help you immensely if you're going to be in a bad situation, as I'm going to outline below. If the airdrop happens and it is being sold on the market for a really high value, and later on in the year, the value completely tanks, you're going to have an enormous amount of ordinary income. And unfortunately, if you have a loss from selling that, the amount of loss you can take against that ordinary income would only be $3,000. And the remainder would carry over until you have other short-term capital gains in future years, or it just carries over $3,000 against your ordinary income for the remainder of essentially your life, unfortunately. Now, this is where talking to a tax expert comes into play, because depending on your specific situation, depending on how the airdrop is structured, they can apply the rules in the Internal Revenue Code against your specific situation. So because crypto is considered property, they can look at the guidelines of property. So, like I said, per the IRS revenue rulings, they outline that an airdrop, as defined in the fact pattern listed in the revenue ruling, is considered ordinary income, which means that if that individual gets that airdrop and has custody of the asset and the ability to sell the asset on the open market, they're taxed at an ordinary income rate. So, for instance, let's say you receive an airdrop and the value of all of your tokens on the day that are being traded are approximately, let's say, $2 million. Okay, so you have $2 million of ordinary income that year. Now, because you have so much money in the market with this airdrop coin, you keep tabs on it every day. And over the course of the year, you see the value just decreasing. And eventually, before the end of the year, it goes to $1. And at this point, the company announces that they're no longer focusing on the project. They're no longer going to do the coin. So what the taxpayer is essentially faced with is $2 million of ordinary income on an asset that now only has a fair market value of $1. So as you can imagine, the tax implications of that is approximately about $700,000 of federal tax due on that airdrop coin for the year. And the amount of loss that the person will be able to get to carry over for the remainder of the year is about $1,997,000. So because of that huge loss, it's all short-term capital loss. And because of the fact that it's short-term capital loss, you can only net it against short-term capital gains, which would be other investments that you hold. Well, chances are that if you're losing $1.9 million in an investment, you're probably not going to want to participate in that investment ever again, especially if the IRS's guidelines are telling you that you also need to pay tax on that. So it very well could be that this person would never invest in anything again because they just got burned so badly on this airdrop coin. And so I want to make it a point that if this happens to anybody, if any of you have a large tax bill ever, when you're doing a return by yourself, or there's new regulations coming out that you're not quite sure on, you need to talk to a CPA or a tax attorney, because they will be able to help you immensely. And you also need to realize that these revenue rulings that we're talking about here are the IRS's interpretation of tax law. So a CPA or an attorney can help you apply your specific situation to the tax code in a way that you're not going to be able to do just reading the revenue rulings. And because of that, I just want to briefly mention some of the contradictions that I see in these revenue rulings as a professional. This is not advice, but this is just some contradictory guidance that we're getting from the IRS in how to treat this property, whereas the IRC code treats property a certain way. And the way that they're treating crypto is not in the same way that they treat crypto in the current regulations that are law and passed in the Internal Revenue Code. So an example would be that Revenue Ruling 2014. And it's still standing and not superseded by any other revenue rulings. They haven't strucken this down. And that ruling stipulated that crypto is to be treated as property. It gave rise to the inclination for many professionals that crypto could be treated as a like-kind exchange, because these professionals looked at the revenue ruling and said, okay, you're throwing us a bone here. You're telling us that it's property. So we're going to use the Internal Revenue Code to our advantage, and we're going to use this and utilize it for our clients to defer taxes. And so it was a great thing during that time. But, it could go both ways, really. If you look at the IRC code, it basically was a specific identifiable property. And in order for it to be a like-kind exchange, it had to be like-kind property. And so as a tax professional, when this was going on, knowing what I knew about cryptos, I realized that a Bitcoin was not equal to an Ethereum. So if a Bitcoin is not equal to an Ethereum, to me, it's not like-kind exchange. And because it's not like-kind exchange, we steered away from doing like-kind exchanges for crypto. And as it turned out later, the IRS did give guidance on that and pretty much stipulated that like-kind exchanges are not for intangible property, like Bitcoin. And so currently, there are no like-kind exchanges allowed for crypto. So to go along with that, I'm just going to list a couple more examples that are in contrast to the current IRC and the regulation that is actually codified as law. So let's take a look at, just for instance, the airdrop scenario. In the 2019 revenue ruling that they released, they stated that airdrops are taxable as ordinary income, like I stated at the beginning of this video, but they didn't define them as currency in the 2019 revenue ruling. So as a professional, I look into this and I say, okay, this must mean that they're treating it apparently as property received in exchange for services rendered. So that begs the question, is your specific airdrop that you're receiving from this company for services rendered? Are you going to do services for this company? Or is it incentivized for you to participate in this company's environment or scenario? Or is it more of a gift? And so this is where your tax professional will be able to sit down with you and look at the specific project and either decide, are we going to view this as a gift or are we going to view this as an exchange for services? And so in the IRC, when somebody receives a gift of property, they get the basis of the gifter. So whatever the gifter has as basis of the property, the person getting the gift gets their basis. And they're not taxed on receiving that gift until they sell it. So if they don't owe taxes until they're sold, that's a much better situation than what the revenue ruling is telling us we should do with the specific fact pattern that they list for an airdrop in the revenue ruling, because they're saying we need to recognize it immediately as ordinary income. So with this being said, you're probably thinking to yourself, what's the purpose of a revenue ruling if it's just the IRS's interpretation of existing law? And how is that anything useful? Well, revenue rulings basically define a subject area that the IRS is new to, and that they're trying to define specific laws as to how to regulate this environment because it is causing issues. So you might be thinking to yourself, what exactly is the purpose of a revenue ruling then? Well, revenue ruling can be relied upon as precedent by all taxpayers. And even district courts give weight to the revenue rulings over the current regulations passed in the Internal Revenue Code. But the tax court is the exception because they view the Internal Revenue Code and the regulations there over the revenue rulings that the IRS is giving, because in a court situation in tax court, it's you versus the IRS. So the IRS, when they issue a revenue ruling, it's pretty much their counter argument to you in court, which is not going to be viewed as primary authority in tax court. And so you have a much greater chance of succession in tax court when arguing against a revenue ruling. But with that said, you can absolutely rely on these revenue rulings as authoritative sources. And typically, most accountants and most people do rely on these, especially when it adds additional tax deductions or deferral of taxes. And in that instance, they're very effective tools for taxpayers. And if you have such a revenue ruling, the IRS has no basis in challenging your position on your tax return for those deductions. They cannot come back and say that, no, you can't take those deductions that we said were allowable in the revenue ruling. But let me pose the question. In our previous example, what happens when the revenue rulings don't fit a taxpayer's facts and circumstances, and it leads to accelerated taxation, like the example we just listed above? What choices do you have or a taxpayer have if these are primary authority? And also just an interpretation of specific new industries or new situations that are vague in existing IRC codification and regulations. Do you automatically go to court with this? Do you contact a tax attorney immediately and just say, you know what, I'm going to fight this in tax court. I'm just going to contest this. How do you go about it? Do you prepare your return? What do you do? Well, that's why I'm here. I want to explain something to you that, luckily for you, if you are in this situation, you can talk to a tax professional. And I advise that you do with everything. Everything I mentioned on my channel, you need to consult with a tax professional, because the beauty of the Internal Revenue Code is that it has specific fact patterns in it. And if you can get your fact pattern down to a certain situation to where it fits the Internal Revenue Code definition, or it fits a revenue ruling definition, and you can use that to your advantage, and that's what a CPA or a tax attorney can advise you in. And it's very useful, especially when you're dealing with large amounts of money. In my previous example that we just talked about, if you're going to get an airdrop of $2 million in an area, in an industry that is very much undefined, you need to talk to a professional. So how does a professional help you in this situation? Well, that professional forms a reasonable basis for taking a position that's contrary to the revenue rulings that are out there and the specific fact patterns that are laid out in that revenue ruling. So in order for this to work, they need to have a 20% chance or greater to succeed at litigation, meaning that the position that the professional develops is arguable, but fairly unlikely to prevail in court. They will disclose the position on Form 8275. Now, it's important they disclose this on Form 8275 because it prevents further penalties if the IRS reassesses the tax or comes back with an audit. If they reassess the tax and come back with an audit and you haven't filled out Form 8275, there will be hefty penalties to pay. The penalty for understatement is 20% of the total tax due. So in this situation, if you have a $700,000 total tax due and you didn't report it initially on the return because you felt you had an arguable position, but you just didn't disclose it, you're going to be fined $140,000 because you needed to pay $700,000 in tax as defined in the revenue ruling, even though you may have very well had a great argument, but you just didn't disclose it on the return. So this is where I'm saying that a tax professional absolutely can help you in this area. And it can help you substantially. Even if you have to pay them $500 an hour to do so, it's wise for you to do this, because in that scenario, they would just save that person $140,000. Now, I want to make it clear here that a reasonable basis cannot be met if there's a failure to make a reasonable attempt to determine the correctness of the tax position that you're stating on Form 8275. If it's unreasonable, like I said, there's going to be harsh penalties. And the preparer who's preparing the return, if you're going to a tax preparer, somebody who may not have experience in the IRC, may not be getting the amount of education that a CPA or a tax attorney are required to get every year through continuing education. you're going to be subject to those penalties. And the preparer is also going to face a penalty for putting a position on there that isn't very well backed up. And as I stated, this disclosure effectively allows the taxpayer to file a return, avoid the penalties for the substantial misunderstatement, and basically the taxpayer pays their taxes in accordance with those circumstances the professional has outlined on Form 8275. And if the IRS does not agree with this, which they will manually review these forms, they're going to be notifying the taxpayer of reassessment. It can lead to an audit. And ultimately, if the audit comes back and they're denying the logic that's listed on the Form 8275, if it warrants, you can pursue litigation. And you're going to need an attorney for that, because an EA or a CPA is not allowed to represent clients in any court of law. A CPA or an EA can, if they have a United States tax court certification, to basically practice law in the tax court. But over the years that's been available, which I believe it's been available for more than 20 years, there's only like 160 people who have that authority, who are tax professionals who've earned that certification. So it's an area where EAs and CPAs, if they are not a JD and they don't have any legal experience and they're not a practicing lawyer, that we don't dive into. And that's why we form relationships with tax attorneys to be able to handle these complicated situations when it makes sense for our clients. And I want to make it a point here. Contrary to what many people think, what an EA may think, what a financial tax preparer may think, these forms do not automatically trigger an IRS audit. It very well could. I'm not saying it can't, but you still need to do everything. You need to disclose everything, and they carry an immense amount of risk by filing this form. The risk is much better than not disclosing. You never want to not disclose these situations to the IRS, because as we know, they're actively participating in blockchain exploration. They are tying addresses to users. This is an area where you need to disclose everything. Every area is an area where you need to disclose everything, especially if you're taking a position that's contrary to the revenue rulings. It absolutely has to be disclosed on the tax return. And as I said, just imagine that. We're talking, there's a difference in that situation that I listed at the start of this video of $140,000 penalty if you don't file this form, along with paying the $700,000 in tax. So by having a relationship with a tax professional, they could have essentially saved somebody who wanted to pull the wool over the eyes of the IRS and not admit the transaction $840,000 in federal tax and federal tax penalties. So this is why I say you need to have a tax professional. You need to have somebody to navigate these unknown waters with you, because doing so as an individual with no background in taxation, no background in law, and if you're a business, if you have no background in accounting or business, is severely detrimental to your well-being. So please find a tax advisor. Just find somebody who can help you, and you're going to be in much, much, much better hands than trying to fly solo with this. So why do I specifically mention a CPA and a tax attorney, and I don't mention EAs or enrolled agents? Personally, it's basically a distinction between education, continuing education, and expertise with more than just tax law. Let me compare the two for you. So a CPA earns his or her license by having 2 years of work experience under other CPAs. They also have a college degree, and they have over 150 semester hours of college credits, of which 20 to 30 of those semester hours are in curriculum that consist of specifically accounting, taxes, and law, and primarily business law as well. And so they're also required every year to take 40 hours of continuing education in their areas of practice, what they primarily practice in, along with taking ethics courses. An EA does not need to have any education or degree in business accounting or taxes before studying and taking the EA exams. The exception to that rule is that if they have worked for the IRS for 5 years, they can become an enrolled agent. And then in that case, they obviously would have some work experience in their area of expertise. An EA is also only required to maintain 16 hours of continuing education every year. And so that equates to 2 days of classes over subjects that they may choose, in contrast to a CPA who needs to maintain 40 hours of continuing education or 5 full days of classes every year. And since the fact pattern on 8275 needs to be logically and legally sound to meet the reasonable basis requirements and to avoid those hefty penalties, as I stated previously, it's just critical that you find somebody who you can trust. And I'm just laying out the facts of what it takes to get a CPA license and what it takes to get an EA license. And if you find somebody who's an EA that you want to use, you can certainly do that. But I just want to let you know the hierarchy of education and what skills they have to be of use to you. Because if you are going to be in a situation at a later date in time to where you're going to be running a business, you're going to need some accounting help, you're going to have bookkeepers, and you're going to need to scale up, tax planning with estate planning, and then you're wanting to start another business or get involved in another partnership, having a CPA on your side will be better than having an EA, just because they are going to be generally a more well-rounded accounting and tax professional for you. You'll find that a lot of accountants, a lot of EAs, a lot of CPAs, anybody who's preparing a return will not want to take a stance contrary to a revenue ruling or an IRS interpretation of the law, primarily because it is work, and primarily because, just like you, they are afraid of the IRS. And I don't feel that you should be afraid of the IRS when you're following the laws and regulations that the Treasury has set out and that Congress has set out. This basically is just an argument between the interpretation of the laws between you and the IRS. And yes, it can escalate to going to court. And if that's the process that you want to follow, that's why we have our friends, the tax attorneys. And if you don't want to follow that, your CPA or your EA can do a cost-benefit analysis on the situation. And you ultimately, as a taxpayer, would have to decide on what to pursue. But that's not to say that you shouldn't have the argument, because, as I stated previously, I think it's worth having the argument over $700,000 of tax. And I also think that you need to disclose it, and you also need to be aware that not disclosing it can lead to $140,000 in tax penalties. And if they're going to find out about these transactions anyways, and they're going to raise an audit flag, you combine those two and you're going to be in the hole for $840,000 if you don't talk to a tax professional. So obviously that's scary. Even if it's, a couple $1,000s for some people, that is very detrimental. So it's worth the time to talk to somebody. Form 8275 is not a complicated form to fill out for somebody who understands the Internal Revenue Code. And the form is primarily there to lift burden off the litigation system and allow people to basically take a stance that they believe in with the current laws. And if it can be justified on that reasonable basis, you're going to be saving a lot in tax, and just to have the ability to do that. And if they come back, and they very likely will, if it's a large tax discrepancy, you can navigate the waters with them. Your EA or your CPA can represent you with the IRS through any of the negotiations. It cannot participate in a court proceeding. I really hope you found this useful. If you did, like the video, share it with people. Sharing it really helps. And so does subscribing. So subscribe for more content. And I really appreciate you watching. Thanks.